How you doing? What we're going to talk about is silver and very significant developments that's going on with the silver market, probably in years. And the mainstream financial media is either ignoring it or completely misunderstanding what it really means. Jane Street, one of the most sophisticated and secretive trading firms on Wall Street, just became the single largest holder of iShares silver ETFs. They acquired 20.6 million shares in the fourth quarter alone. 20.6 million shares. That is not a trade. That is not a hedge. That is a statement. That is one of the smartest money managers on the planet, making the biggest silver bet in the history of the ETFs. In that exact same moment, this news breaks, warning and circulating about the potential financial engineering and market manipulation behind the recent surge in silver prices. So, which is it? Is silver being manipulated higher by Wall Street insiders? Or is one of the most sophisticated trading operations in the world positioning for something massive that retail investors do not see coming? The answer is more nuanced than either extreme. And by the time you finish this video, you're going to understand exactly what Jane Street's positioning means. Why the manipulation warnings might actually be telling you the opposite of what you're thinking. What the mining production data reveals about physical supply and why the combination of tariff escalations, Iran sanctions, and weakening dollar creates the perfect environment for precious metals to continue higher and possibly even explode. Now, I'm Big D, and I want to thank you for stopping in. I want to thank you for pushing my subscribers higher and higher. And if you don't mind, I would like to try to make it to 700 subscribers in a short period of time, which would be amazing. Please like, share, subscribe, hit the bell notification for all, and definitely make a comment. If you make a comment, I'm going to leave you a comment as well. And also, I'm doing a show that to know if you're buying proper metal, and metal that says 0.999% on it is truly 0.999%, along with some other details that will help you so you don't get scammed in the future. Okay, let's get back into this. Now, before we dive into the details, I want you to know where you are watching from. So leave that in the comment section as well. I'm in Central New York. I think at one point I would love to meet some of you guys. I've tried to meet people when I've gone on vacations. Sometimes it works out. Sometimes it doesn't. You know, our times don't click. But I hope to see you all. That would be amazing when this finally comes to an end and our government hopefully gets its shit together. So I want you to know where you're watching from. I truly do. Drop a comment right now, even while you're listening to this, and tell me what part of the country, or if you're in a different part of this world. That would be amazing. I see viewers all over the world on comments, and that's been amazing for me. And I'd like to understand how global this audience really is. Whether you're watching from the United States, Canada, United Kingdom, India, Germany, Australia, Singapore, South Africa, Japan, Brazil, Philippines, wherever you are on this planet, type it in the comment section. I try to read every single response and leave a comment for everybody. Also, what I would like to know, so I can put out a video when the average person is going on to YouTube and watching. I don't know if it's during the day and you're sitting there, you're at your desk, you're typing away, you're driving your truck, or you're a mechanic and you're in your bay, and you got it cranking, and you got me playing. Give me the time that you're listening to, and maybe I can submit them at that point and do premieres more on uh, an average basis. No, just take a second and hit that like button. It doesn't cost you anything, I promise. And it does help the channel reach more people who need this information. All right, let's break it down. What is really happening here? Let me start with Jane Street, because if you do not know who they are, you are missing a critical piece of the context. Jane Street is not a hedge fund in the traditional sense. They are a quantitative trading firm, one of the largest and most profitable in the world. They specialize in market making, my bad, arbitrage, algorithmic trading. They trade billions of dollars every single day across every asset class you can imagine: stocks, bonds, commodities, derivatives, crypto. If if it trades, Jane Street is probably involved. Now, what makes Jane Street different from most firms is their approach. They do not make bets based on gut feelings or analyst opinions. They use sophisticated mathematical models and data analysts to identify opportunities. They look for mispricings. They look for information edge. They look for situations where the market is not properly reflecting underlying value. And when they find these situations, they deploy capital at scale. So when Jane Street acquired 20.6 million shares of iShares silver ETFs in a single quarter, that is not random. That is not a junior trader marketing. Sorry, that is not a junior trader making a speculative bet. That is the results of their model identifying something in the silver market that justifies a massive position. They look they have looked at the data, they have run the numbers, they have analyzed the probabilities, and they have concluded their own silver exposure at these levels making mathematical sense. Now here's where it gets interesting. At the same time, this position was revealed warning stating circulating about potential financial engineering and market manipulation in silver. Some commentators are suggesting that the recent price surge was artificially created by institutional players, that the rally is not organic. The rally investors are being set up for a trap. Now, let me address this directly, because I think the manipulation narrative is being misunderstood and potentially weaponized to shake retail investors out of their positions at exactly the wrong time. Let's acknowledge some reality. Yes, the silver market has been manipulated in the past multiple years. Major banks have paid billions of dollars in fines for spoofing, layering, and other manipulated practices in precious metal market. This is documented fact. JP Morgan was busted. They had to pay a fine of almost $1 billion. But the amount of money that they made, way over the almost $1 billion that they had to pay. And they are still allowed to do this. It doesn't matter if it's JP Morgan or any of the other BlackRock or any of their other banks that are manipulating silver. The question is not whether manipulation exists. The question is what direction the manipulation is pushing prices and who's benefiting. Here's what I want to do to consider: if a large institution wanted to accumulate silver at a lower price, what would they do? Would you put out bullish reports encouraging everyone to buy, which would drive prices higher and make their accumulation more expensive? Or would you put out warnings about manipulated and financial engineering, scaring people, investors, into selling which would push prices lower and make accumulation cheaper. Think about that for a second. The manipulation warning might themselves be a form of manipulation, not manipulating, not manipulation of the price directly, but manipulation of retail sentiment. If you're convinced retail investors that the rally is fake, that it is engineered, that is about to collapse, what happens? Retail sells, price drops. The institutions with the capital and conviction to hold through the noise accumulates the shares that retail is dumping. I am not saying that it's definitely what is happening. I am saying that you need to think critically about who benefits from the narrative you are being told. When Jane Street is buying 20 million shares while warning circulate that telling you to be afraid, ask yourself whose interests are being served by your fear. But let me give you some context in the price action because silver just dipped below $90. This is a couple of days ago now. And then yesterday it bounced back. I read around $95 before close. I know some of you are watching the screen all nervous and may silver prices drop again. Yeah, it's possible. Very, very possible. Now pull back slightly. It's a volatile market, especially for gold and silver. The dollar index is at 97.57 on the surface. That looks like a risk off. Precious metals are pulling back, but let me show you what is actually happening beneath the surface. The pullback coincides with a market, but cautious ahead of the latest round of talks between the United States and Iran and Geneva. When geopolitical negotiations are imminent, traders often reduce exposure to wait for the outcome. That is not bearish. That is prudent risk management once the talks conclude. Regardless of the outcome, clarity returns, position gets rebuilt. Meanwhile, the United States just imposed sanctions on more than 30 entities supporting Iran oil and weapon sales. This is an escalation, not a de-escalation. More sanctions mean more tension. More tension means more uncertainty. More uncertainty means more demand for the safe haven assets. The pullback you are seeing is happening again, a backdrop that is fundamentally supportive of precious metals. And here is the tariff situation. U.S. Trade Representative Jameson Greer announced that Donald Trump would sign a directive to raise global tariffs to 15% where appropriate. Now, this comes after the new 10% duties took effect this week. We are not seeing tariffs come down. We are seeing tariffs go up. And as tariffs increase, supply chain gets disrupted. Inflation pressures build. Investors seeking protection in assets that can't be tariffed. You cannot put a tariff on gold sitting in a vault. You cannot put a tariff on silver you already own. So when you see silver down 2% on a day, when the fundamental backdrop just got more bullish, what are we actually seeing? You're seeing a shakeout. You're seeing leverage traders getting stopped out. You're seeing weak hands terrifying their positions to strong hands. More or less, hold your silver. What is speculation on silver prices and gold prices in the future are unbelievable. But when you look at the data, it is more than believable. You are seeing the exact kind of volatility that precious metals have always exhibited, and that separated long-term winners from short-term losers. Don't forget, until this shortage started happening over the last few years, several years actually, You used to see a 20, 30 cent swing in a day trade, a full day of trading of silver and gold, or, well, not gold, you can't go with that. 20 to 30 cents on silver itself. Now you're seeing $2, $5. This is not normal. So if it's not normal and it's ridiculously volatile compared to what it used to be, you got to get used to it. Keep your emotions out. Don't allow them to push you into believing their lies. Now, when you saw silver drop below 90, that was your emotional reaction that, and if you dump silver, because it came right back. I mean, like I said, it was about $95. I believe it was yesterday afternoon at close. If you did dump your silver, do you feel regret for not selling it higher when it was 120, 121? Do you feel the urge to dump your position before it goes lower? Like, do you believe it's going to drop back to 50? Remember, it was only June of 2025 when silver was $30 an ounce. Or do you feel calm, maybe poised to see the future as $200 silver, $300 silver? I'd like to know. Leave it in the comment section. I do appreciate it. Maybe even excited at the opportunity to add to your position at a better price. Buy the dip. Your emotional reaction tells you how well positioned you are psychologically. If you cannot handle 2% pullback without wanting to sell, you are going to get shaken out before the big move that makes holding worthwhile. Now, let me talk about the mining production news, because this tells something important about physical supply picture. Nickel mining just announced that they are ramping up production of a high-grade gold and silver concentrate. They have transitioned their processing from gravity and flotation recovery to flotation on, I believe it's called, circuit, to suit their new mill feed. New technology coming into play. They are optimizing their operation to enhance metallurgical recoveries, improve concentrated grades, and maximize payable metal content. Here is why this matters. When mining companies are investing in optimization and ramping up production, it tells you that they are confident in the price environment. They would not be spending capital on upgrades if they expect prices to collapse. Their actions reveal their expectations, and their expectations are bullish. But here's the nuance that most people miss. Even when mining companies optimize and ramping up production, the increase in supply takes time to materialize and is typically modest relative to total global demand. Mining is a slow business. You do not flip a switch and double output. You make incremental improvements over months and years. Meanwhile, demand is growing faster than supply can respond. The CEO of Nikola stated that their integrated mining infrastructures provides operation leverage to strengthen precious metals and the base metals market. Operating leverage to strengthen markets. The CEO is not hedging. He is not being natural. He is explicitly positioning the company for continued bull market in precious metals. Now, these are people whose likelihood depends on understanding the supply-demand picture, and they are acting bullish. Let's connect all these threads, because this is where the analysis gets powerful. We have Jane Street on one of the smartest firms in the world making the largest silver ETF positions in history. We have mining companies ramping up production and optimizing operations in anticipation of strengthening markets. We have the United States escalating sanctions on Iran and increasing tariffs on a global trade. We have the dollar weakening, and we have silver pulling back slightly after a massive rally, creating what could be an opportunity to enter or add to positions. What picture does this paint? It paints a picture of the market that is fundamentally supported by multiple factors experiencing normal volatility and being accumulated by sophisticated players, while retail investors are being warned to stay away. Let me ask you a question. If Jane Street is wrong, what happens? They lose money on their silver positions. That is bad for them, but Jane Street manages risk meticulously. They do not make concentrated bets without conviction based on data. The fact that they are willing to be the largest holder of this ETF tells you that they believe their edge is significant. What if Jane Street is right? What if their models have identified what silver is undervalued relative to the fundamental supply demand picture? What if the combination of industrial demand from solar and EVs, investment demand for monetary uncertainty, and supply constraints from years of underinvestment in mining creates a setup for dramatically higher prices? In that scenario, Jane Street makes a fortune, and real investors who sold because they were afraid of manipulating warnings missed the move. I know what scenario I would rather be in and prepare for, but you have to make your own decision. And please see my description and my well, let's move on. But I would rather be prepared, but you have to make your own decision based on your own analysis and risk tolerance. Now let's talk about the technical picture, because this gives us levels to watch. Silver futures dropped to 89.81%, or $89.81. The key level that needs to hold is around 85. That is the support zone that has been tested multiple times. As long as silver holds above 85, the bullish structure remains intact. A close below 85 would suggest more downside is possible and would require recessing the short-term output. On the upside, the resistance is at $92, which was a recent high. Above 92, the next target are $95, and then the psychological $100 level. Given the fundamental backdrop, I expect these levels to be tested. The question is timing, not direction. Gold is holding above 5,000 despite the pullback. Spot gold is 51.97, remaining in the structural repricing phase that analysts have identified. The 12-month target from major institutions remains $6,000 and higher. The medium-term target extends to 7,500. A pullback to 5,100 would be a normal correction within that larger trend. Now, a break below 5,000 would require more serious attention. The dollar index at 97.57 continues to show weakness. A weaker dollar is supportive of precious metals because it makes them cheaper for foreign buyers and reflects underlying stress in the monetary system. Now, if the dollar continues to weaken, that is a tailwind for gold and silver. I want to address something that I think is causing confusion for a lot of people. The relationship between paper and physical markets. Jane Street bought 20 million shares of the SLV ETF. This is a paper claim on silver. It is not physical metal in their vaults. So does their purchase physic does their purchase actually affect the physical market? Yes, it does, indirectly. When shares of physical silver ETFs are purchased, the fund is supposed to acquire actual silver to back those shares. The authorized participants who create the new ETF shares have to deposit physical silver into the trust. So the increased demand for ETF shares ultimately translate into increased demand for physical silver. But here is the nuance. The ETF system works smoothly when physical supply is abundant. When supply gets tight, the system can experience stress. Premiums can emerge between the ETF share price and the underlying metal value. Authorized participants might have difficulty sourcing metal, and the paper price can diverge from physical reality. This is why I always emphasize watching the physical market signals, lease rates, the COMEX inventories, regional premiums, the backwardizations. These tell you whether the paper market is accurately reflecting physical reality or whether stress is building. Right now, those signals suggest stress. Backwardization persists. Inventories are declining. Lease rates are elevated. Physical premiums in Asia are extreme. Jane Street buying 20 million shares in this environment is not just a bet on price. It is a bet that the paper market remains connected to physical reality, that they can convert those shares into value when they choose to exit, that the system continues to function. This is a significant assumption in a market that's showing signs of physical stress. Let me give you a scenario that to think about. Suppose Jane Street is right about the direction of silver prices. Suppose silver rallies to $120 over the next year. In a normal market, they would simply sell their ETF shares and book the profits. Easy, right? But suppose physical stress intensifies. Suppose they are delivering failures on the COMEX. Suppose the ETF cannot source enough physical silver to back all the shares in circulation. Suppose a trust event occurs with confidence and paper claims collapse. In that scenario, Jane Street's paper shares might not capture a full value of physical silver. The people holding actual metal inside the system would benefit disappropriately. I am not predicting a systematic failure. I am pointing out that the choice between paper and physical exposure has implications beyond just price direction. It involves assumptions about the continued functioning of the financial system, and those assumptions are being tested more severely any uh, than at any other point in recent memory. Let's bring this back to you, because ultimately what matters is how you position yourself. In Jane Street, with all of their data and models at sophistication, is making the largest silver ETF bet in history. What does that suggest you should be doing? At minimum, it suggests that you should be paying attention. At maximum, it suggests that you should be positioning for the scenario that they are betting on. But here's the key. You have to do this in a way to match your risk tolerance and time horizon. Jane Street can hold through 20% drawdown without blinking. They have the capital and the conviction. If you are going to follow the smart money into silver, you need to be able to hold through volatility. You need to have a plan. You need to know your levels. You need to understand why you own what you own. The worst outcome in buying is buying because Jane Street is buying, then selling when the price drops 10% because you never had real conviction. That turn Now that turns their good trade into a bad trade. Position sizing matters, conviction matters, patience matters. Let me ask you something else. What would Jane Street have to see to become bearish on silver? They would need to see the supply deficit resolve. They need to see industrial demand collapse. They need to see investment demand fade. They would need to see central banks stop accumulating gold. They would need to see the fiscal trajectory of major governments improve. They would need to see trust in fiat currency store. None of those things are happening. All of those things are moving in the opposite direction. This is why I keep emphasizing the structural nature of this bull market. It is not driven by technical patterns or speculative fever. It is driven by fundamental forces that are not reversing anytime soon. The industrial demand for clean energy, technology continue to grow. The investment demand for monetary uncertainty continues to build. The supply for mining continues to lag. The deficit continues to compound. The inventory continues to drain. A 2% pullback on Tuesday does not change any of that. It is noise. It is the market doing what markets do, especially in the last several years. And that's testing conviction, flushing leverage, creating opportunities for those who understand the big picture. Let me give you some specific things to watch out in the coming days, because these will tell us whether this pullback is a buying opportunity or to start something more serious. First, watch the outcome of the Iran and U.S. talks in Geneva, which we have already seen that as of this morning, this has escalated into bombings, and the U.S. is already in position, and it doesn't look good for Iran. But keep the soldiers and Iran people in your prayers. Now, talks have broke down, so we know the direction is what's going on now. Now, there might be some brief profit taking before the structural trends reassert themselves. Second, watch the tariff implementation. If the 15% tariffs get signed, which either it already has or I'm believing that it's going to, this is an escalation that supports precious metals. The market might initially sell the news, but the medium term implications are bullish. Third, watch the dollar index. If it continues to weaken below 97, that is a tailwind of metals. If it reverses and strengthens back above 98, that creates short-term headwinds. Fourth, watch the ETF flows. If Jane Street positions, it's being followed by other institutions. We see continued inflows into silver ETFs. Now, large sustained inflows confirm the smart money thesis. Fifth, watch the physical market signals. Lease rates, premiums, inventory levels. These tell you whether the stress is increasing or decreasing. If the stress increases while prices pull back, that is screaming buy signal. Let me close with something I want you to really internalize. The presence of Jane Street as the largest holder of the silver ETFs is not a guarantee that silver goes up. Smart money is not always right. Models can be wrong. Unexpected events can change the picture. And definitely check out my description and my disclaimer in the description below. I am not a professional, but I do a lot of research, and I have a lot of help from many of you. And because of that, I can put these types of shows together. But when one of the most sophisticated trading operations in the world makes a record position in an asset, it is telling you that their analysts suggest opportunity. It tells you that their model sees something. It tells you that the risk reward in their judgment favors being long. Do you have to follow them blindly? You don't. But you should take their positioning seriously. You should ask yourself what they might be seeing that you are not. You should consider whether the manipulation warnings being circulated are meant to protect you or to separate you from your position. The silver market is volatile. Again, it always has been, but it's not been this volatile. The last several years have been crazy. It's always has been some type of volatility. And I think it always will be. Now, that volatility is the price of admission for the returns the metal has delivered over the long term. You cannot handle the volatility. You should not be in the market and use your emotions for buying and selling. But if you can definitely handle it. If you understand the fundamental picture, if you position appropriately, then pullbacks are not something to fear. They are something to embrace. Jane Street is embracing this market. Mining companies are embracing this market. Central banks are embracing precious metals. They haven't been. So that should be another indicator. Now, institutions are accumulating. The question is whether you will be on the right side of this trade or whether you are going to let the fear and manipulation warning shake you out at exactly the wrong moment. I know where I stand. I have shown you the data or talked about it. I have walked you through steps, through the logic. Now you have to make your own decision. Again, drop a comment in the comment section. I'll leave a comment for you. Let me know if you even knew about Jane Street and if this is the type of information that you like to hear on a regular basis. Now, do you trust the smart money? Do you think the manipulation warnings are legitimate? Do you think silver is going higher or is it a trap? I want to definitely hear what you have to say. I want to know what your perspective is because this community gets smarter when we share ideas and challenge each other's thinking. Also, tell me where you are watching from if you haven't done so. I want to see the global reach of this channel. Make sure you subscribe. Just try to get me to 700. That would be amazing for me. Try to have a great rest of your day. And keep your emotions out of it, hopefully. I know it's difficult. But if you've been a stacker for a long time, or you just began in the last, several months, it is difficult. But remember, silver is volatile. And it for the last several years of being in a deficit, it's become more than normal. If you see a $2 to $5 swing up or down, that's the way it is. That is just the way it's been. So try to have a great rest of your day. Have a great rest of your weekend. And God bless.